Hi, everybody. Welcome back to another edition of VCTV. I'm your host, Kyle Ellicott, and we are here to speak about early stage investing. What does that mean for you as investors, and what does that mean for you as founders? Now, to take a quick step back, when we looked at the latest data coming out of PitchBook and some of the other major companies that track multiple funding rounds, we actually noticed that Q3 investments were down this year in 2020 over last year. But that was not necessarily the case or going to be the case going into Q4. And we're still waiting on that data as we're almost wrapped for the year. But Q4 2020 could actually see a small little bit of a bump. We also could see more fundraising going into early stage companies next year in 2021. My prediction is that we will, but we'll leave it to the experts to give us those data points when they come out. But we brought together some of the best and the brightest from around the world who have made investments at the early stage and or have funds that are starting to deploy capital in this area to talk just to us about what's happening at the early stage level. What are valuations looking like? What are some of the investment instruments? Where are the areas of opportunity, the industries, and some of the journeys that you need to be aware of if you're raising early stage capital, and also how to track and manage. One of the biggest pain points when raising capital at any stage, but particularly the early stage, is managing that flow. And what are some of those tools out there that you should be aware of and things you should be conscious of when you're going out for your first fundraise? That's what we're here to talk about. But before we get started, a big thank you to you, our audience, for tuning in. If you're liking what you hear today, make sure you click that big red subscribe button to tune in all day, every day on VCTV and all of our great episodes with all of our great, exciting panelists from around the world coming to you live every single day. And with that, also a big thank you to the LA Token team and Maria for making VCTV possible every single day. And if you're loving what you hear today, either as an investor or as an entrepreneur, and you'd like to contribute to VCTV, either as a speaker or would like the chance to pitch us in real time, your company, product, or service, and get real-time feedback, plus build foundational relationships with us as investors and get exposure to our live audience, reach out to the team and or myself. We'll find the right spot for you. And again, a big, big thank you, as we're incredibly thankful on this special day today for the LA Token team and Maria and everyone else behind the scenes who make VCTV possible every single day to bring us all together on this wonderful Zoom room that we get to enjoy. And with that being said, let's introduce our guests today who have joined us from around the world to share their insights. Gianpaolo, welcome back. It's a pleasure to see you today, and a little intro background for everybody.
Thank you, Kyle. Welcome, everyone. I'm Gianpaolo Parigi. I'm a venture capitalist in a nutshell, and today we speak about early stage investments. So I think you want to know that I am a VC and ready to share some experience, ideas, and whatever insight I could contribute for what the future will hold. Back to you, Kyle.
Wonderful. And Gianpaolo, you also are part of a family office as well, and we'll love to hear your take in a short bit on the family office perspective, early stage investments, as that's becoming a rising trend here in 2020, where family offices are now starting to make more direct investments into early stage ventures. But we'll come back to that in just a little bit. That's a tease for the audience. Jason, welcome back as well. Happy Thanksgiving on your side of the world, and to all happy holidays. But a little intro and a little background.
Great. Thank you, Kyle. Glad to be back. My name is Jason Jacobson, managing partner of Propellant Ventures. We are based in Chicago in the US, and we're focused on investing in early stage companies throughout the Midwest in B2B industries such as healthcare, future work, fintech, edtech, and supply chain. I also run the Founder Institute chapter in Chicago. It's a global accelerator that many of you probably heard about, and I've been running it for almost 10 years in Chicago. And all of our founders are at that pre-seed or seed stage. So I'm very active in that community as well, looking at those types of opportunities. And overall, I've been very active in the entrepreneur and investment landscape throughout the US, primarily in the Midwest, for the last 20 years. So glad to be here, Kyle.
Wonderful. And real quick, speaking of Founders Institute, you guys seem to host, it looks like weekly, based on LinkedIn, a very exciting little event, which looks like it takes place in the metaverse. In virtual reality. Is that something that you invite both investors and founders to kind of commingle in the metaverse to talk about investing and founding of companies?
Yeah, so we traditionally in Chicago do something called Founder Night Out, which is a monthly happy hour environment for entrepreneurs, investors, and those in the ecosystem. Typically it's in person, but since the pandemic, we went virtual in April. And one of our grads in Chicago, GamerJibe, created this 3D virtual environment. So we've been doing these since April, just about every month. And it's a 3D virtual environment where you walk around in an avatar, meeting people one-on-one or small group discussions. So we have Startup Showcase where we have founders that pitch their businesses, and then we get investors and other people. So we get, on average about 100 people at these events. And it's been pretty neat. It's very different than something like this. It's just a different engagement.
Very cool. I've been wondering, so I had to ask. I just keep seeing these screenshots on Jason's LinkedIn of him as an avatar walking around. I've been meaning to ask. So those that are listening either in the Midwest or globally, if you want to join in, reach out to Jason and we'll get his contact information at the end.
One thing I'll mention, sorry, Kyle, so they do a happy hour every week, GamerJibe. So if you want to check it out on December 3rd, go to gamerjibe.com. You can check it out on December 3rd, and it's open to anyone.
All right.
A
little metaverse happy hour. Thank you. Joining the Oasis. Here we are. Pep, welcome to the show. First time. If you can, a little intro and a little background.
Sure. Greetings from Estonia. It's 6 p.m. It's dark. It's raining. We don't do Thanksgiving holiday here, but to you guys, happy Thanksgiving. And my background is such that I started about 23 years ago in sales and a management training company, out of which the software company Pipedrive was spun off about 10 years ago. And I was the founding investor. Two of my guys who were part of this sales and management training company came up with the idea and attracted three other fellows from the IT world, and that's how it happened. So now we're in the middle of the acquisitions by Vista Equity Partners, which is still an ongoing process. And I am kind of new in this investing world, even though I did make this one bet, which landed into the unicorn land. And so I'm more and more excited to see what you guys are doing and what's going on, and have made some investments already. And so that's my story in short.
Wonderful. Thank you. And for the audience, if you haven't checked out Pipedrive, I will do a shameless promotion. In terms of the tools we spoke about in the introduction around managing that pipeline, hence the name, of investors and your sales process, definitely check out Pipedrive. It's a great tool. I actually have used it during fundraising processes as well, and it's a good little tool, but we'll come back to that. Another teaser for you. Last but not least, the grandmaster of artificial intelligence, the one and only, the Yoda of AI, ladies and gentlemen. One I'm thankful to be joined with again today, the turkeys of turkeys, Gary Fowler.
The stuffing of stuffing. Thank you very much. I didn't even know what to say. If it was a Bill and Ted's Excellent Adventure, I'm not worthy. I'm not worthy.
I just got going. I apologize. It just kept going. I just couldn't stop.
So, I was waiting for the cranberry. So my name's Gary Fowler, and I'm a serial investor. I started the first startup academy in Russia at Skolkovo School of Management. I've done 16 companies, 2 unicorns, Click Software I was on an original team of. Today, I'm the CEO and president of Get Shit Done GSD Venture Studios, premier venture studio, working with AI companies primarily from all over the world, from Indonesia, from Dubai, Russia, Belarus, all over the world. Stanford University, we have one. So we curate those companies. Our goal is to take them to unicorn status. I mean, a lot of people talk about it, but it's actually, we get in and do it. I've been doing this stuff for over 30 years. We're located in Silicon Valley. So we're a Silicon Valley based a studio, and we're looking for incredible companies that want to go global. Thank you, Kyle.
Thank you. And again, thank you everyone for joining today.
That's
really
great.
excited to, very excited to dive in today's topic. Again, as I mentioned, early stage investment is a two-part equation. From an investor's side, it's a risky bet, as Pat mentioned. Sometimes it pays off, sometimes it doesn't. As entrepreneurs, it can be a very taxing process to raise that first round of capital. And here in 2020, things have dramatically changed in some cases. Again, We've seen less capital deployed in early stage companies this year so far. Year is not finished yet, but next year we could see an explosion of that. As well as more and more new companies have been founded this year already. And so we could see the opportunities there. Jason, I want to start with you. I mean, how have things changed, maybe even from a valuation standpoint, as that's typically the first question everyone wants to know about fundraising here in 2020. Looking from the beginning of the year, come full circle to where we are now with just about 4 weeks left in the year. How have things changed for early stage investments this year in 2020?
Good opportunities are always going to find capital, no matter what the market is. So companies are still getting funding. There is plenty of capital out there. There was a slowdown a little bit when this pandemic kind of get going and people weren't sure what was happening or what to do. A lot of VCs were keeping their reserves focused on their existing portfolio, and they didn't do as many investments. But with that said, new investments are happening now as people figure this out, and new companies, as you mentioned, are being built during this time. I have seen some valuations or valuation caps have gone down a little bit, and it really depends on the region as well. In the U.S., specifically in the Midwest, valuations are generally more reasonable anyways. The coastal valuations are usually higher, and some of those have had to come down. But I haven't, and I think there's a delay. Also, I don't think a lot of it's moved yet, but I have seen some people move the numbers down just to be more attractive to investors. And it's also some of the discussions I've had with investors where they think it may be a little high. And so again, they're trying to be more attractive either way. And so this environment is, I think level set some of those expectations, or some of the valuations have had to go down. Companies have modified their business models to stay afloat, and they've gone after new markets that maybe it was something they're thinking about in the future, but that's accelerated itself. And so as they become stronger once the pandemic is over or gets, people get back to more normal activity, they've got new markets and new customers that they're going after. So if they can continue to execute well, they'll actually be in a better position. And so the stronger companies are those that can adjust and adapt during times like this. And again, they'll be stronger when we all come out of this. So I'm very hopeful, and I've seen a lot of great things so far.
And thank you, Jason. John Paul, I want to come to you for the other side of the world, but I know you look at companies on a global scale. I mean, how have things changed from your perspective around early stage investments over the last year, or over the course of the year, pardon me?
Well, in terms of our attitude, and not only I think my own, but investors' attitude in general, nothing changed. There's been just a decrease in investment in the third quarter, and we know that for a fact in the United States. In Europe, about 50% quarter on quarter on a year-on-year basis. We'll see what the last quarter will yield in the West and also in Asia, but I think what has been lacking in the market is primarily the business angel money and I would say smaller high net worth investors' money, and which are normally groups that tend to populate and preside over the area of early stage. So it's not that these people all of a sudden became poorer, it's just that they have been hanging on to their liquidity given the uncertainty of the markets that we have seen through the pandemic. I mean, in some months, the market sentiment was not really, optimal for early stage investment. So if you go into deals that are, over 20 million and over 50 million, basically you see nothing really has changed on Series A rounds. But most companies, around the world are not looking to raise, I would say north of 20 million. But I think, this will have to change also founders. I mean, this is an investor's market. There's a lot of liquidity out there, but, liquidity now means way more than it used to mean even 1 or 2 years ago. And so there's a lot of dry powder, as Jason said, and but it's going to be employed, I would say, and not with hostility, but definitely, at the benefit of the buyers and the investors and the underwriters, rather than the founders necessarily. So I am seeing a market which is tilted in favor of the investors in 2021. I do expect, as you said, Kyle, as well, if not a recovery in the investment amount, at least a moderate stabilization path. They say hockey stick, but moderate hockey stick going up, and again in terms of quantity of investments released on a global basis. But I think a lot of things have to change in terms of how startups are approaching the market. And there's also the possibility for some of the ventures to raise debt, which is something I've been working on over the last 2 quarters substantially. Not all ventures can be reconverted fully to debt or partially to debt, but those that can be reconverted, restructured, are significantly increasing their likelihood of raising capital internationally.
And just to clarify real quick, Gianpaolo, when you refer to debt, you mean venture debt, right? Another instrument that founders can look at as fundraising potential.
Not necessarily. I'm talking about actually plain straightforward debt. Because convertible notes are, and mezzanine is assimilable to equity anyway. So it would get you through the ordeal. They go through the eye of the needle anyway in terms of the structuring, the placement, the registration filings, whatever it is that you have to do, which entails and involve having capital for those who help you or assist you raising, from CPAs to attorneys to investment bankers, brokers, whatever you have out there on the field, boots on the ground working for you. And because at the end of the day, as I say, they're all assimilable to equity. They're expensive to deploy, and they are, requiring a longer timetable. Debt is much cheaper, faster, and safer to a degree. As I say, it doesn't apply to everyone, and of course, but there are many alternative lenders out there we're working with that are considering, let's say, a little bit, more leniently the companies, particularly companies that have promising intellectual property rights, and there's a lot to do, and I think creativity can be applied together with experience to mold the structure. Some of the companies, I like to equate this to changing a little bit the DNA of the companies, because founders are, most of the time having a tunnel vision. They scream for equity, but hey, I tell them all the time, you don't need equity, you need capital, capital that you can repay comfortably. And the reality is, if you can service debt, you can also make the equity investor satisfied, because chances are that if you are not in the position through your business model and income generation model to service a reasonable debt at very low interest, like the ones that we have today on the market, on the global markets, you are not going to be very satisfactory anyway in terms of performance also for the equity investor. So you're only, let's say, shifting down the line your potential issues, but those issues nonetheless will arise maybe 2-3 quarters down the line, and investors may not be satisfied with how you're running your business anyway. So a lot of things can happen depending on what you have put into your covenants back then. So it requires a paradigm shifts on the founders, but it's a nice exercise. It's also rewarding and intellectually rewarding and challenging professionally, but I think it's where a lot of arbitrage opportunities can be had for early stage investors like us and others. Thank you.
Well, it's a great point, and thank you for clarifying that as well and going in depth on that, Gianpaolo, because traditionally there's when founders think to fundraise, there's usually one path and one path only, or one path to follow. But now today we're actually seeing multiple different opportunities for capital infusion into a company at the early stage, whether that be a syndicate, whether that be a high net worth individual, a business angel network, a venture capitalist, an early stage venture capitalist, a family office. These types of venture debt or debt traditionally, as you're speaking to, along with different types of notes of SAFE to SAF, so equity versus tokens, depending on the industry that you're in, a combination of the two. And then we're also seeing, the rise of government grants as well, and incentives or schemes that also play a role. these non-dilutive investment capital that can come in, which for an early stage venture really can change the game for you. And going back to that conversation of equity, can actually help you grow without having to worry about restructuring the company or structuring the company for equity displacement and dilution later on. And so to the audience, Gianpaolo brings up a very good point. And this is actually something that if you are out there fundraising, you should be looking at all of the options out there, and there's plenty. But to his point as well, make sure it's the right one for you. Explore and then also do the research and see if it's the right fit. But there's tons and many more to come as well. And I would say there's probably never been a better time to fundraise because of the amount of opportunities and options that you have. And with that, both Pep and Gary, I want to come to both of you on this next question. And both of you were founding investors and founding team members of very successful companies, we'll just say. And congratulations to you both. What made you choose to be an investor into such an early stage, risky, I don't know what's going to happen type of an idea, and then also be a little bit of an operator? And Gianpaolo and Jason, I got a fun question like that for you in just a moment. So hold on for just a moment. So Gary, let's start with you. I mean, Click Software and some of the other companies that you founded, you went all in. You were both the founding investor and you're a founding team member. I mean, what made you want to take that risk playing both sides of the table?
Well, Click Software was a little different because I was hired by Oak Investment Partners to come into an Israeli company. So I was on the original team of it. But I can tell you with my first company, because I didn't know any better. And I started to do what Gianpaolo said. I started to do loans. I borrowed money from my family. I borrowed money for the bank. But what I didn't understand is I was personally liable for that money going into it. The good news is I made a lot of sales. The company grew like crazy and it wasn't a big deal, but I didn't realize the risk because I was 21 years old. So going down through it, I mean, it's part of the game. I mean, you never know going into these. You don't know if you're going to have a, pipe drive or you're going to have a Click Software or Eva. When you go into it, what you do is you hope I don't think there's any startup out there that says, oh, I don't want to make it. Every one of them wants to make it. But but now when I'm looking at it from my standpoint, I look at it as an individual investor, right? I look at it from my standpoint is what kind of team do they have in place? Do they have revenue as a company? I mean, it's critically important because if they have, so I look at it as I call it startup 3.0. 1.0 is acceleration, 2.0 is regional dominance, and 3.0 is an opportunity to be able to go out and go global. And so at 2.0, what we're looking at is I know that they have product market fit. I know they've got some revenue, and I say critical revenue for me is about $20,000 a month MRR, because I feel like they got their act together and they're ready to go. But in terms of, I talk to VCs, I deal with about 300 VCs regularly. And one thing I can tell you, and everything from SoftBank down, is that people avert to risk. And if they're dealing with an early stage, pre-seed company, there's a lot of risk, always a lot of risk. But even now with COVID, there's more. So one thing that I do is as I said, if they have revenue, I feel that they have product market fit, if they've gone down through and proven the model, it's interesting. Then I look at the team, right? Is the team really a flexible team that has got the flexibility to do something dynamic? And also, if the CEO doesn't fit, are they open to be able to changing out, or are they one of the persons that say, I'm not going to ever leave, it's my company? It's not interesting, because they probably will have to leave if we want to grow the business. So those are the kind of things I look at. And then, today offers an incredible world, Kyle, because through this, and COVID isn't going down, unfortunately, it's record levels today, literally today in the US. So we've got a unique situation where we have to use the medias like we are here today to be able to get the word out. And it's not so easy if you're a startup that's in the Czech Republic or Indonesia to be able to get the attention of Silicon Valley. I say Silicon Valley because Silicon Valley for me is a port to the rest of the world, right? So if I want to raise money from Japan, from Tacoma Ventures, I go there. If I want to get it from T-Mobile, and Deutsche Telekom, I get them out of San Francisco. So using that as a port, it is a little different because a lot of what we do is based on trust. I mean, I can't tell you how many VCs I've talked to even today that said, you know, the only way I'll invest in a company is if somebody recommends the company that's another VC to me or is invested in it, because it takes the risk out. It's vetted and you feel comfortable. So we're in a unique world. The good news is it's really given all opportunities. It doesn't matter if you're in Africa or Indonesia or the US or the UK or Estonia. Everybody's got an equal playing field today. Now the question is, how do you use it wisely? You know, it's like the Indiana Jones movie. How do you use this thing wisely? Because if you do it right, this is the greatest time for visibility that we've ever had. I mean, literally, I'm with this. I wrote the CEO of one of the largest companies in the world yesterday, and I got a response back, right? It is unprecedented. That would not happen in normal times. So use it while you have the opportunity to get out, because it won't last forever. And when we come out of this, there won't be as much of this digital transformation as we have today. Yes, there'll be some, but it won't. The opportunity is today.
Mm-hmm. I mean, you're absolutely right. And just one point you made is that warm introduction and how important that is. And this is going to lead up to Gianpaolo and Jason in a moment, but you don't really realize, and I'll say this having been on both sides now of the table. And as a founder, I didn't realize, I heard it, thought it, didn't believe it, but kind of believed it, that warm introduction really can change the game for you. And now sitting on the other side of being an investor, seeing how impactful that introduction, that referral, that recommendation to another investor can have for a founder, it's very, very impactful. And to your point, as the game has changed here in 2020, and as we look to 2021, we'll probably continue, is you have to lean on those warm introductions when raising capital, and it's something you should. And also, as we talked about in other previous episodes of VCTV, when you do go out to fundraise, talk to the investors and some of their portfolio companies and ask how those investors support the companies, how they've worked with the companies, how they help the companies during early spring and summer this year, because that will show you kind of how this investor or investor group can be supportive and will be there or will not be there for you in the future as well. But Gary, that's a great point. And Pep, I want to come to you. I mean, you have an incredible.
Kyle, can I say one more thing? You know,
Please.
it's so important. I mean, I put together this, you know, I'm still actively involved with my acceleration stuff, but I actually put a group together. And what I did is with startups, I tested it just to see it would work. And I got some of the top investors in the world involved. And I put a 10-week program where I put them in as mentors. And I mean, top investors in the world. What has come out of it is actually extraordinary. There's actually, because they got a warm, and they became his mentors first, and he started working with them, they're now investing in those companies. It's unprecedented. I've never heard of anybody do it. Now, a lot of these are personal friends of mine, but guess what? They've talked to their friends. Now these companies are some of them they're early stage. I'm doing it basically as a service to kind of help them out. I don't take any equity, anything like that, but it's amazing how this thing is really starting to transform. I've never seen anything like it in my life. And I mean startups from Argentina. I mean startups from Germany, Indonesia, all over the world coming in, and it's working. So there is a way to get through this.
It leans into the point that it doesn't happen overnight.
It doesn't.
There's many pieces.
Yeah,
there's many pieces to the process.
The relationship, that personal relationship, because it's a trusted network. And that trusted network, I trust your judgment. If you send somebody over, Kyle, to me, I know there's a good probability that they're vetted and they're good people to work with and you think their idea is valuable. But if I see them, I get inundated with, I mean, I don't know how you are, but even in LinkedIn today, I'm inundated with people trying to get a hold of me. You know, it's unbelievable. So I'm trying to filter through it as much as I can because I don't want to leave anybody behind, right? But it's hard.
And that goes back to adding context for anybody reaching out on LinkedIn. Add context so you don't fall through the cracks. Pep, I want to thank you, Gary. And Pep, I want to come to you. I mean, you've had an incredible journey, and similar question. I mean, you went in both as a founding investor and as an operator, and now are going back into investing. What made you kind of decide to play both sides of the table in the early days of Pipedrive?
Well, what we did with Urmas Purda and Timo Rein, who were the creators of the idea of the Pipedrive and the co-founders, is that we were helping local businesses to improve their sales and the business in general. So we did basically in-house custom-made, tailor-made sales training seminars. And so after some time, Murmas and Timo got sick of it. They said, we want to make money when we sleep. And so we happened to visit a Finnish entrepreneur and a training king, Jari Sarasvuo, back in 2006. And he had just actually bought a local IT company. I think it took a Microsoft service. They sort of packaged it up different, and they're trying to sell to big companies. And so we got really inspired by that. But there must be a better way to help companies and make money than just doing seminars. I sort of launched into the motivational speaking seminars myself, but those guys were really working with companies. And so what I just remembered about 10 days ago is that they made initial investment into my training company in 2004 out of their own pocket. And so when they came to me asking for investment in Pipedrive, I don't think I took more than a few minutes to decide, because I was almost morally obligated, but also they were friends. I knew what they were capable of. They had been working together for 10 years. So I wasn't sure at the time how big it might be or could be, but I was sure that something would come out of it. And so I didn't hesitate at all. And so I kept working in my field while they worked in two fields. And then so soon they left. I bought back the shares that from them in my company, and so the rest is history. So it was sort of a moral thing, but it was also like a no-brainer, because I knew these guys. You know, we worked together for 10 years from the very beginning.
That's another great point too, is that relationship, right? You've worked together, you've built this relationship, you've seen success and struggles along the way, and decided to reinvest in each other. And which kind of brings me to my bigger question for everybody. And Jason, Gianpaolo, I want to start with you. And both of you have funds focused on early stage. I mean, Jason, your fund is completely focused on early stage of all sizes, all the way up through early Series A. And Gary, you yourself are founding a new fund focused on early stage. Pep, you've been making investments now in the early stage. What has shifted you all to stay in that, either shifted you back to early stage or kept you focused on early stage investing, especially now as companies are staying private longer or getting bigger quicker? What makes you excited to make these investments at such an early stage level? And Jason, we'll start with you.
Well, that's the space that I've operated in the most of my career in the entrepreneur and investment community. As I mentioned, I run the Founder Institute, so it's also very early stage pre-seed. That's super early. And so also I've seen a gap in the market with real early stage stuff. There are funds that start at this level, but then as they raise their second or third fund, they get bigger and they're moving up the chain, and they're not focused as much on the early stage investments. And so this is where I spend most of my time in. This is where I get a lot of the opportunities. I have opportunities for later stage deals, but I see a bigger gap keeps on widening with early stage deals and pre-seed and seed deals. And you had mentioned, you're right, VCs or companies don't necessarily raise VC, usually sometimes past the seed stage. And so you can miss on some of those opportunities if you don't come in earlier. And so coming in earlier also helps them to raise more money. If there's some institutional money early on, that can add some additional credibility and help them raise additional capital, whether it's through angel groups or other VCs. And they need help in this space. The network I built over the years, I'm supportive of entrepreneurs. Every day I connect them to different resources. And so I feel I can have a real impact in helping these companies as well at this stage.
And thank you. And Gianpaolo, same question to you. I mean, this is a risky game, 1 in 10, which we know is not always true, but I'm just throwing that out there. It's a risky game to be in the early stage, and both on the venture side and the family office side, you're making investments. What's keeping you in this?
Well, I think we were serial entrepreneurs, so obviously there's a lot that we can transfer in terms of what we've learned starting our own ventures into what we invest in terms of angle, really, of attack of the market. But especially, I would say the greatest single contribution would be avoiding most of the pitfalls. Because if you think the vast majority of companies die before year 3. And you said 1 out of 10. Unfortunately, if people knew exactly, the batting average, nobody would become an entrepreneur for a long period, because it's actually way, way lower than 1 out of 10, the ones that are successful. In Silicon Valley, we used to quip that, you got to juggle with the 20 balls and only one will be good and 19 bad. But again, even that one is not, not even close to called. So it's the average of company, a number of companies that can make it past the initial 3 years, it's really apparently meaningless. But those are the companies that are, bringing the world forward, and not only the unicorns that are giving big pushes to the world at once, but also a myriad of other relatively unknown companies that prop up the economy and grow, and increase the level of wealth across geographies. So I think, why do we participate in that? Well, I do it with two hats. A single family office actually invests most in infrastructure deal, proprietary deal on middle market. So we don't invest in, third party early stage, but I do it through an entity that I've organized with other partners. And well, it's because, we have several reasons. I say we are serial entrepreneurs, so we relate, we have empathy with those founders. We can give a lot, not only capital, but primarily intellectual capital. We can provide relationships and introductions, and I say expand the comfort zone for, like Gary said, other fellow investors that are coming in, seeing that there are some other investors on board. Obviously, that doesn't guarantee, that the company will be successful, but it would contribute to the risk, the venture. And at the end of the day, this is what we're all looking for as investors, de-risking our ventures. And last but not least, because obviously there's more money and profit to be had, in an early stage than in a mature company. So, if you know how to de-risk ventures and you're comfortable with the environment, it's a beautiful position to be in, and it's such an exhilarating experience, because you are really on a daily basis in contact with, again, the generation of innovation, new intellectual property coming out, the enthusiasm of not only young people, because there's a lot of startup founders that are in their 40s and even 50s, but there's still an enthusiasm and an angle and ingenuity brought to the market, which it is really like fresh oxygen, and it's beautiful. And you nearly become addicted to that. And, and there's a lot that can be done at that level. You have an influence on the companies. You can really bring together very good professionals and entrepreneurs to help on their board or to advise along the sidelines. So there's so much that can be done, and you can really make a contribution and having an impact. So I think this is the answer of why we are in that space.
And I'll just say, the older I get, I think the more excited I get to build. And be on that side as well, to your point.
I just wanted to add something, because Gary mentioned his experience as a young founder back then, and he secured debt, but he had to do it on personal guarantees. I forgot to mention when I spoke about debt that none of the transactions that we are building nowadays based on debt involve any personal guarantees on the founders. So, the market is propelling itself forward, and there are different possibilities. So we are using this. So it's important for founders that want to consider debt, maybe with us, to understand and to know that it can be done so without, as I say, forking up personal guarantees. I think it's very important.
That's a great point. And hey, Gary, transitioning over to you. Same question. You're building a new fund. You've got a $100 million fund. You're focusing on areas of the underserved. You've also got some other investments that you're doing. To the same question to Jason and Gianpaolo, why early stage? What keeps you excited at the early stage?
Well, you want to keep your finger on the pulse of what's going to happen, because those early stage companies become the Pipedrives or Click Softwares of the world. So you want to make sure that you're there. If you talk to VCs, right, they're watching companies for sometimes 2 to 4 years. So you want to get in the middle. I get in after, as I said, after I'm sure they have product market fit and they have some revenue. Because it's, if not, there's a whole lot, it's a different kind of scenario, right? Going down through and getting them to the MVP. And you may have to take a deeply operational role to get them over that hump. But yeah, I mean, the thing is, you don't want to wait too late. And if you understand the environment, and we focus on artificial intelligence. So our companies are from all over the world in AI. And we don't talk about it. We, deep AI, unsupervised AI, ladder networks, VAE, those kind of things across multiple vertical markets. So these are the companies that are going to be the next Twitters or Salesforce. And I remember actually got a chance to meet Salesforce when they first got started in their first office. So, I mean, I've seen the transitions of the companies, or, Broad Vision or Siebel Systems. So that's how they start. You never know when it starts, but you do have a feeling, because you can tell the team's resilient and able to move forward. And, once they get knocked down, they get back up. It's not one. I look for that a lot. Do they have those kind of experiences?
Siebel Systems, bringing one out of the closet. That's an old company. For those who may not know it, check it out.
Yeah. My friend was one of the original. So P. Hong Chen was some of the original money behind Siebel, and also Sinan, China, Ufida, many, 20, probably 30 projects. And I remember P. Hong when he was talking, he was the first e-commerce company. It was called Broad Vision. And I remember he said it's a $30 billion cottage industry, and people were laughing. This is late 90s. And his stock went from $6 to 2,000. And I happened to get investment from him, and he happened to fund my company, Broadient, which is one of the first e-commerce consulting companies. And I was fascinated. I'd never seen anything. I saw it go from nothing, and he said, Gary, this isn't the first time. I sold Gain to Sybase for $100 million after 6 months. Seriously. And I'm like, and Tom Siebel was his VP of sales, right? And then he invested in Siebel, right? Siebel spun out, and he was one of the original investors in Siebel. And the rest is history. That's how it works.
I would say it's a full circle process. And, Pep and Jason, I want to come to you both next on tools. So managing the process of early stage investment as an entrepreneur can be exhausting. Managing that pipeline, managing that deal flow. And Pep, totally take the shameless promotion and talk about Pipedrive here. But to both of you, what are some of those tools that you may recommend to entrepreneurs to manage this process, to really start looking at and doing research around finding investors, and again, managing that flow and communication? And Pep, we'll start with you. And again, feel free to shamelessly promote.
I might a little bit, but I think the main thing is the ambition, and how do you reach out, and what kind of a reputation have you built and are you building? Will you feel trustworthy, and will you be believed if you state out your ambitions? And I'd like to chip in also for the previous question. Estonia is very sort of populated with the startups, and it's very almost like a national sport, like a national pride. And having seen one be taken to Silicon Valley and back, and then to this unicorn level, it's really, really exciting to see younger, and not only younger people with their dreams wanting to propel forward. So I also look at it as a sort of almost like a social mission, to helping those companies that have the guts and have the structure and a good cause that I happen to believe in. And so back to your this last question, is that the Pipedrive especially was meant for salespeople. So that who are selling personally and making bigger deals, and with the sales process within which you would need to have several different steps and stages and actions and meetings and whatnot. And so I think it's quite usable also for fundraising, because when you have number of potential investors, and then of course you will have a smaller number within which you are approaching or making some contact, and so they have asking some questions, and then you're hopefully having some meetings and proposals and term sheets going back and forth. You need to juggle those balls from the entrepreneurial side, if you're lucky to have many, with whom to do what at what time at your responsibility. So I also feel very, very comfortable of shamelessly promoting Pipedrive also for that particular job.
Thank you. And Jason, to you, same question. I mean, tools that you would recommend for entrepreneurs that are looking to manage that process.
Yeah, so entrepreneurs are bootstrapping, as we all know, and so they're going to spend their money on some things over other things. And I think many people just use a good old Excel spreadsheet to get started, or HubSpot, free version of HubSpot. I mean, something to organize your meetings and your thought process in your notes. And so I think HubSpot is definitely better for that in terms of Excel. But again, I believe that it's things that were mentioned before, just making sure you have some good progress, good story to tell, and have those relationships to find investors. And so whether it's using LinkedIn, which is a good tool to get in front of people, but I believe it's leveraging the existing network that you have. I mean, I get deals coming to me quite often, like all of us do, and it's a big part of it's through my network, and that adds credibility. So you want to build up your network to get in front of those investors. So again, keeping track of all that could be through Pipedrive, could be through HubSpot, could be through Excel. I mean, it's obviously those are all different tools, but just making sure you're organized, that you keep track of when you've contacted someone, when you should follow up with that person, and just, if you need a calendar reminder, whatever it is, using some of those tools, but just making sure on top of it as best as possible. So I don't think there's a silver bullet for this, but there are tools for sure to help you manage this better. And but just organization is key, however you do it. And
shamelessly watch VCTV. That's all. That will help your success. But outside of shameless promotion, gentlemen, I want to come to each of you for one big final question before we come to close here today, and that is, where are the untapped markets for early stage investment, or where are the opportunities that early stage investment can have a real impact on right now, that are getting either you excited or you're seeing just from your own research as well? And Gary, let's start with you.
Yeah, so I mean, the thing is, the market's everywhere, right? We're finding companies I go where people don't go. I went to Russia in 1992 when nobody was going there at the time. And then I moved over there in 2001 when people said you can't do startups, they're hard to deal with Russians, et cetera. And I worked in that part of the world, including the Baltics. So where I'm going now, I'm looking everywhere. I'm out looking everywhere for them. I'm finding companies in Argentina, in Chile, in Indonesia, in Bangladesh, in Africa. I mean, I'm looking everywhere for them. The thing is, today it's a little bit different because as we have this democratization of opportunity, they're coming out of the woodwork. But the other thing is, it's not so easy to find the investors, right? That's why having VCTV is really good, because they have a Jason and Gianpaolo, Pete, yourself, myself out there to be able to get the word out. And it's critically important today because they don't know where to go. And so it's great for me. I mean, I'm finding literally people all over the world. I write a lot, and so I get a lot of visibility on that side. And then we also try to support very good causes and do the right kind of thing. So we're getting a lot of governments and VCs contact us because of some of those efforts. We do impact kind of things, and it's a 360-degree view. It's never been easy to find companies. If it would, everybody would be billionaires. It's a situation as you got to look, and Estonia is a great place and everybody knows it, but where's the other place now, right? Tallinn's a great place. It's wonderful, but maybe it's in Novosibirsk, or maybe it's in Omsk, or maybe it's in Jakarta. So we want to look everywhere. And I had said before that a lot of talent is located in certain places. That's true, but I got to tell you now, it's a little bit different because I'm finding that talent in a lot of places, and it's different than what I had said before. So it's unique. I have one company from Stanford University today that's an AI company. I'm a co-founder of it. It's a health tech company, but that's normally you would think of Stanford University, right? But you wouldn't think of Bangladesh. So go where people don't go. I mean, Warren Buffett said, what did he say? You always go in the opposite direction of the market, because if you go in the market, you're probably going to lose money. Go in the opposite direction. Look, think differently.
I like that. And Gianpaolo, to you, same question.
Well, Gary and I back then used to quit because Gary started Russia in 92. I started Russia in 88, and people were looking at me like I was really totally nuts, to go to those markets where I could have had it much easier in Europe or in the US. But actually, this is what really makes the opportunity. And nowadays, the markets are really global. I've been investing in Estonia, I've been investing in Indonesia, I've been investing in Singapore. I've been doing business with China since '94, and South Africa, the Emirates. There's opportunities everywhere. It's a little bit like the items that you find in the duty free in the major airports around the world. There's I would say a wide variety, but it's all the same around the world, because now the sets of skills are being commoditized, and you can find them in Jakarta, in Rio de Janeiro, in Helsinki, or in Michigan. It's just more or less the same. There are bright people that have been educated in leading universities, or anyway, there's a lot of talent that has been just self-educating and on online and through the grapevine. And I think it only rests to be seen whether you want to be in that geographic space or not. But I think there are opportunities across any industry sector and across all geographies, really. It's only a matter of, where you want to have your fun. The only thing that I want to add on that is, it's just like on early stage, it's like, a man riding a horse across the desert. And if you ever stumble onto water, the first that needs to drink is the horse and then the man. So you remember that, you have to ensure the survival of your ventures so that they can, morph into larger companies, and if not successful unicorn, at least successful larger companies. Thank you, everyone.
I like it. Thank you, Gianpaolo. That was great. Pep, to you, what areas are you seeing that's super exciting at the early stage right now, or opportunities?
You mean areas geographically or business-wise?
Either industry or geographically.
Geographic, I'm a beginner. I'm not going to bullshit you. I'm just looking around, and I'm seeing what I see locally here. And Estonia seems to be a great place. I think that what I was told the other day is that the Estonian founders seem to hold on for longer. They don't quit that easily. They may not make it big, but they're going to hang out for the first 2 or 3 years. And so, but also having spoken to other guys who do investments here for a longer time, we look around also Finland, we look around Central Eastern Europe, Israel. We just made an investment into the Finnish VR, AR company, 2 young, brilliant guys, 22 years old. It used to be Finns and Swedes that came to Estonia and made investments back in the day. It's kind of fun to be on the opposite side now. And so, I'll rest my case here. So I'm not going to be making up things about stuff I don't know.
No, that's a great perspective. I mean, this is why we're all here on VCTV, to provide all these different perspectives from all stages and all types of investments. So thank you, Pep. And Jason, close us out. Where are you seeing the areas of opportunity right now?
Yeah, so it's a big reason why I started my fund, and my fund's thesis focuses on the opportunities. And so specifically here in the Midwest in the US, companies are generally lower value than the coastal companies, and we need more early stage capital in the Midwest. And so I see the Midwest as a great opportunity for that. We've had some of the highest investor returns out of any region, and Chicago specifically has had the highest returns out of any city throughout the country. Now there's smaller numbers of investments, but in terms of the returns, they've been pretty high over the last 10 years. And so the geographic region here is great. Some of the industries I mentioned also, we're a B2B region. So healthcare, future work, fintech, ed tech, supply chain, those are industries that are being impacted right now. And there's a lot of growth and investment in those industries. And so those are initial industries we're looking at, but we will look at others, but B2B is our main focus. So there's a lot of great opportunities there, definitely. And think these technologies have been accelerated. The adoption has been accelerated because of what's happening.
I love it.
So I'll leave it at that.
That's perfect. So with that, we're going to come to closing thoughts. And then, of course, where can everyone find you online to continue the conversation about not just early stage investing, but maybe even share a little bit about what they're doing or opportunities to co-invest together. And Gianpaolo, kick us off. closing thoughts, where can everyone find you?
You can find me here on VCTV, which is a great tool, I think, for investors and entrepreneurs and consultants, I think, to learn, to share experiences, and also to present their cases. So we're always happy to listen to them. You can find me on LinkedIn. You can find me on my webpage, giampaoloparigi.com, or via email. Our email is giampaoloparigi1@gmail.com, on Instagram, on Twitter. You can find me all over social. Thank you all.
Wonderful. Thank you, Giampaolo. Gary, any closing thoughts? And of course, where can everyone find you to continue the conversation?
Hold on. Sorry about that, Kyle.
No worries.
Yep. Sorry about that. Yeah. So closing thoughts. I mean, this is a great opportunity. As I said, I've written the article a few weeks ago called Democratization Opportunity. And I think this is a great time for the startups. It's, get shit done, get out there and get them. Don't let it get you down, dust yourself off, get back up. Investors do have money to invest. They're looking for incredible opportunities, and they're not as geographically bound as they've been before. You can reach me. I love AI. I love early stage companies. If you have revenue, that's a bonus point. They're bonus points. Come on in. You can reach me, Gary Fowler, on LinkedIn. You can reach me at gary@gsdvs.com, Twitter, etc. Or you can reach me through VCTV.
Thank you. Thank you. Pep, closing thoughts, anything to add? And then, of course, where can everyone find you online to continue a conversation?
Primarily, I want to thank you and LA Token for inviting me. It's like I spoke to you before we started the call. It was a bit of a surprise, and a nice one, just like you promised it would be. So thank you for that. I think two main ways to reach would be perhaps over Facebook, first name, last name, Peep Vane. We pronounce it a bit differently, but that's beside the point. And the most direct way would be my email, first name @lastname.ee, pep@vine.ee, or as you Americans would say, peep@vane.ee. I actually lived in the States back when I was a younger man, and I had a terrible time with that name.
Well, we are so happy to have you here, and we'll do a better job of making sure everyone pronounces it correctly in the future.
Now it's all right, but back in the not so confident 22-year-old, I was having a hard time.
The early 20s, as we've discussed, are a special time in all of our lives. So we were all there at one point with you, and thank you. And Jason, last but not least, close us out. Any closing thoughts? Where can everyone find you online?
I just think it's a great time to be an early stage investor and entrepreneur. There's a lot of money out there and a lot of opportunities out there. So, finding those synergies is perfect. Just leverage your network to find those opportunities to meet investors and vice versa. You can find me at LinkedIn, of course, as well as Propellant Ventures website, and then jason@propellant.vc is my email.
Wonderful. And all, thank you so much for giving your time today and sharing your thoughts and insights here on VCTV. We're incredibly thankful on such a special day, and happy Thanksgiving and happy holidays to all of you as well. And thank you, Jason. To those tuning in, again, thank you so much for tuning in. If you like what you hear, click subscribe, give us a thumbs up, do reach out. Thank you, Jason and Giampaolo. Gary, if you would like to be on a show like today, do reach out. Thank you, Beth. We would love to find the right industry topic or region around the world to have you a part of a panel just like today's guest to share your thoughts and insights as well. And entrepreneurs, there is a virtual stage here for you on VCTV to get real-time feedback from investors like each and every one of us and founders focused on your area. Get real-time feedback on your company, product, or service, build foundational relationships with each of us, and get exposure to our live audience. What better way to celebrate the end of 2020 and looking ahead to 2021 than something just like that? Do reach out to the team and or myself. We'd love to find the right fit for you. And also, before we get to the final things, if you have the chance to reach out to all of our investors today, again, make sure you add context that not only you heard them here on VCTV, but what you're following up with them about, whether that be on LinkedIn, respected social media sites, and or email as well. And again, last but not least, an enormous big thank you and incredible thanks to the LA Token team and to Maria for bringing us all together, and not just today on VCTV, but all days, every day on VCTV as well. Everyone have a great great rest of your day and week. With that, I'm your host, Kyle Ellicott. You can find me at Kyle Ellicott on all social medias and all of our investors as well on social media.